Clarity is the most important asset in uncertainty. When markets get shaky, risks are everywhere. Crypto pulls back, commodities rise, investors run to gold, silver, even copper had a tremendous surge. The green periods in the chart show when gold and silver outperform Bitcoin. Bitcoin has a stronger connection to the risk curve, which is why it is correlated with equities. Gold and silver behave differently. That's why they are outperforming right now. Earlier this year, we saw equities and Bitcoin sell off as gold rallied. It is because the driver of the sell off did not have anything to do with an internal domestic recession, but an external balance of payments risk, which is tariff. In simple terms, the global system has been centered around the dollar's reserve currency status, which creates imbalances in its current account and capital account. When you have money moving around in the system like this, it creates a surplus of dollar liquidity directly linked with trade and cross border flows. The current account in the US has been in free fall for years now, which represents the entire import and export relationship, meaning the US imports way more than it exports. Bitcoin and crypto sold off right now as gold and silver continue to rally is an indication that Bitcoin is not functioning as a global safe haven nor digital gold for those risks. It still functions like an equity, especially as treasury companies take large positions and cross collateralize it with more debt. Everyone is talking about Bitcoin treasury companies, but no one is thinking about the fact that gold miners have outperformed MicroStrategy since the beginning of the year. All of these actions are moving us towards an endgame in the global financial system where the credit cycle is taking an outsized significance in the melt up and the coming meltdown. In the previous video, we mentioned we have to see volatility as a fee and we get paid to hold risk. If you want asymmetric returns, you need leverage of wisdom, information, and capital. If you use leverage, you must keep a small margin for error. To minimize error, you need to understand how and why things happen. That's where our community comes in, cross-checking and referencing different signals across multiple time frames. The bottom line is that Bitcoin acts as a macro liquidity sponge, similar to gold during easing, directly linked with credit risk in the system. Gold and silver are a release valve for liquidity directly linked with duration risk and cross-border flows in the system. Understanding the difference between Bitcoin and commodities isn't optional. It's fundamental, which we will get into more in depth in these aspects in the next video.